Good morning, ladies and gentlemen. Well, another week goes by and the indicator just does not get any better. Minus 21, it is, if we look at the weekly closes for the past few weeks, minus 34, minus 22, minus 28, minus 21, basically no change. And you can see what the moving averages are doing. The red one, which is the most important one, is still headed to below zero, and really what we want to see is these moving averages converging, which is what we have. From minus 40 we're now down at minus 34, but that is still quite significantly negative, and they're basically building a base from which to break one way or the other. As I've been saying for quite a few weeks now, we are at a very important juncture. If we look at the deviations, and we can actually have a look at the major page here, we will see that we backed off the 2864 level a few weeks back, and now we're just going sideways, building this springboard for the next move, which is going to be either significantly higher or back down somewhere in the 2700s, low 2700s, or even lower. It's significant that this upper deviation, two standard deviation, is actually not widening, but it's narrowing. It's telling us that the market, the risk reward of buying up here at 2864 is extremely bad, because even if you vault over the 2864 level, the two standard deviation and the red comes in at 2877. So that really is not very much, is it? And it's very dangerous to be long up here looking for very much at all. It is unlikely to happen. The market stays in the red very rarely and for a very short period of time, as you can see here. We need to spend more time in this area to allow this to widen out. This is a very bad risk reward area to buy at the moment. Well, what are the bonds telling us? The bonds are telling us that we are still in a deflationary environment. What we said last week still stands. Eventually the Bund will trade minus 16. And at the moment it's just meandering in this lower box of yield between minus 2 basis points and minus 16 basis points. Nothing much to write home about. This is what we did for many weeks back in 2016, and this is what I expected to do for many weeks now in 2019. More things change, more they stay the same in bonds. They cannot get away from the zero bound, and when that happens you get a situation like this, where the market just stays in a very narrow range, and we just cannot break through this minus 245 basis points differential between bunds and 10-year notes, and that tends to keep the dollar absolutely range bound and in check. We need to either break through the minus 245 or through this minus 258, 259 basis points area, and that will give us a sustained move in the US dollar until and unless we see that it's completely range bound and nothing at all to do there. The 10-year note yield, as I said in my tweet, it's either going to stop just short of that area of 233, or it's just going to piss straight through it. It stopped just a couple of basis points short. It would be normal now for it to retrace to somewhere around the 249 area, 250, and then go again. To me, this is just a retracement to be bought in the 10-year, in the 5-year, and in the 30-year. If we look at a longer term chart of, say, the IEF, this certainly is not a picture that you would fade. It is quite likely that after a bit of consolidation we get a move back up to the 109 area. 109 is absolutely pivotal, and you can see how close all these pivotal ranges are between 109 and 110. That is going to be very, very difficult to break. Very difficult, unless we have an absolute nightmare in the economy. So to me, this is not a sell. This is going to be a retracement that refreshes somewhere to around 105, and then we go again. I really would not want to be short of the futures for a point, sure, but not for very much at all. To me, the trend in the interest rates is very much lower. If we look at TLT, it is not overbought as yet, and we are approaching this very important pivotal point at 127.37. All these levels I've had here for years. These are not levels which change. Yield levels don't change, and the market will trade this 127.37 for sure. I would love to see it back down, retest this line from above. I would love to see the market somewhere around the 123, 123.50 area. That would be a great buy, I think, to see this 127, and if we bust through it, then 132. Keep these levels in mind always when you're trading or investing. Those are going to be very tough levels to break. The market will touch them and then back off like it did many times. So those are profit-taking levels you want to get rid of your positions at. But at the moment, any pullback towards the 123, 123.50 area is going to be a great level to rebuy the TLT. I always try to get confirmation of one view from other related markets, and this is VIX. To me, VIX, when it gets down to the 1225 area now, or it'd be lovely if it filled this gap here, which has been left since October, 1167, that would be a wonderful area to be long of volatility. And this actually confirms the view that 2864 is going to be a very tough level to break with any conviction. And as I showed you earlier, even 2864, although it gives us a change in long-term trend, it actually projects only another 15 points before the market is too tired and comes back and breaks 2864 from the upside, which actually would be a huge trap for all the bulls. Would be lovely to see. So 1225 in volatility, and then on a fill of this level, 1158, 1160, that would be absolutely lovely to see. Would adore to be long of volatility at that level. If we go over to SPX, you know, we have our level. It, you know, here it says 2860, but it's actually 2864 on the SPX, as we determined, to be absolutely precise. Here we are. We're going to go and test it probably already on Monday. I don't think it breaks very quickly. I think any move back up to the 2864 is going to be a bit of a bull trap. I would wait for a weekly close above it, because I think it's very easy that this week we just go slightly over, trap everyone, and come back straight down. As I said for a while, certainly for 2 weeks, we are building now a springboard. These moving averages on the weeklies are turning up. Let's enlarge it for you. You know, this is going to be very tough support to break now. 27.50, and below that 27.36. So that is the area that we just don't think is going to be broken on the downside very easily, and this 28.64 is not going to be broken very easily on the upside. You know, not very exciting market. It's not going to go very far either way, but that is really what the fundamentals are telling us, and let's have a look at those next. And here we have our Blue Angels, and you can see actually that the times 16 Blue Angel matches perfectly with that 27.50 area that's going to be so tough to break. And yes, we have started going up in terms of the slope of the Blue Angels, but it's whenever the market is in that kind of a bull market, i.e. just following the Blue Angels, and it's already gone from a low multiple to a very high multiple, and now we're between 16 and 17, we are not going to get multiple expansion anymore like we got here. We are going to basically just follow the slope of it, and therefore 28.64 is going to be very tough to break on a sustained basis, because any disappointment the market suffers is going to go straight down to the time 16, and that is exactly what the weekly chart of the SPX shows us. Since we closed the month, it's interesting to see what the monthly chart shows us, and if we actually enlarge it, it gives us a support level at this red line, exactly where the weekly ones do, 27.43 here, whatever it is, 27.46. I mean, it'll be slightly higher when we open the market today. But that gives you the absolute line in the sand on the downside, because you have both the weekly and the monthly chart pivoting there. So that level around the 27.50 area is going to be very, very tough to break on the downside. We have almost no slope to the Bollinger Bands, and that is really what I've been saying. Even any break above the 28.64, although it gives us a change in longer term trend, it actually doesn't give us very much to aim for in the short term. There's a big difference between, I mean, if it starts closing above 28.64 with regularity, I am going to change my stance to a bullish one in SPX. At the moment, it's very much neutral. It's opportunistic. You buy the dip, you sell the rip. But from then on, I will very much use 28.64 as my support level and be a long-term buyer for long-term moves above these highs, well into the 3000s in SPX. The divergence between the sort of deceptive bullishness in SPX and actually the meh which is provided by the Russell 2000 is quite impressive. As you can see, this is a weekly chart of the Russell Cash. It is nowhere near as bullish as the SPX. It has its line in the sand here around 1613, and let's put it in there just for the future. I would say that that is very much it. 1615, it never got anywhere close to it, and it just broke very, very hard last week, and the week before, and last week it just sort of had an inside weekish in the on the weeklies. It really needs to break this 1572 level this week to give it any impetus to the upside, and I will mark that, and I will now use Russell as a confirmation index of any bullishness in SPX. Unless I see Russell break that 1571 level, this week, to me, this is just trading sideways. And SPX, even though it might be breaking that 2864 level, all it's doing is basically stretching an elastic band, and at some point it's going to have a very, very bad day. So to me, the Russell has to start confirming this bullishness by breaking 1570 sometimes this week. If not, I think we will be in trouble, and at some stage we'll get data which is very, very bad, and we will go back towards that 2750 pivotal area in the SPX, which I've just shown you. The European indices, and this is the DAX, are interesting insofar as they held the 0.618 retracement of the move up of the past 2 years, from 16 up to late 17, then did this ABC kind of back off to the 0.618, and now they're holding in quite well. But they're very, we bought put spreads here at above 1800. We're going to hold them for a long time, because if the market tries and retries and fails to take 1800 and go above 12,000, at some stage it's invariably going to fall down into the 10,500 area and retest these lows. To me, this chart is nowhere near as bullish as the SPX. It has far less potential on the upside in the longer term. In fact, it has immediate negative potential, while the SPX doesn't. The SPX is going to, even if we get some very, very bad data, that 2750-ish area is going to be very good support for a very long time. So to me, European markets just don't have the attraction that the US markets do at the moment. Another note of caution is given to me by EEM, which basically now is so heavily weighted towards China once more that it gives you basically a very good idea of what's happening in all the other markets apart from the US and Europe. This is really an inside week of a very nasty reversal candle. Until we start breaking the 44 level, to me this is a negative chart, and one which presages actually coming back down towards the 40 area and retesting that. So I really cannot get bullish of this formation. To me, this is a diamond which eventually breaks down before we have the impetus to go much higher. So on a weekly basis, until we see consistent trades above above this level, which is 46, I really cannot get bullish of EEM. And to me, the odds of EM dragging down Europe at some stage are actually very, very good. The market theory now is that China is fixed. The stimulus there is going to expand the economy. There's going to be a trade deal on top, and therefore everything is hunky-dory. It doesn't look like that in the price action. So I am cautious. To me, and I will put this line in so we can follow it. To me, unless 45.94 goes at some stage, that's 46, and we start trading above there. Sorry, that's 45.04. Scratch that, 45.04. Unless we start closing above there on a weekly basis, I see absolutely nothing bullish about this market. To me, this is range bound. This is retesting of levels that we, that we basically came through. And to me, this is going to be very, very tough to break. This is the DXY, and don't worry, I am looking at the dollar all the time. I'm looking at it for clues, but basically until it breaks this 97.54 level, with any conviction and start staying above it, I just can't get bullish of it at all. The range is actually constricting. The 200-day moving average is coming up nicely, and in a few days time it'll be up to this 96.50 level, which is so important and so pivotal. So we will actually have a much better level to sell it from if we need to. 96.50 in a few days will become the equivalent of 95.07, so we'll be able to move our trade levels one up, which will be great, because instead of shorting and buying volatility at 93.63, we'll be able to do that even at 96.50. So happy days kind of thing. Absolutely nothing to do here. Why waste your time trading something which trades in a 100-tick range? I have absolutely no idea. We've caught very large moves in bonds, and we will be able to continue catching those moves, because as long as the Bund stays fixed the way it is, 10 years are an elastic band. The more they fall in terms of price in the futures, the more they're going to build up kinetic energy to return to those levels later. The biases for this week actually are not very different from what they were last week. Last week we said basically that we go towards the 230 level in the 10-year. We gave you that range, 233 to 229. We stopped short by a basis point. Now a retracement to 250 would be lovely to see, and basically reinstate at 250 the little bit of profit that we took. This is still buns and bobbles, nothing to say. That is stuck. 0 is about as good as you're gonna get, and minus 16 basis points is about as good as you're gonna get. To me, as I've just told you, 28.64 is still pivotal. To be long now against 28.64 is very bad risk reward, because I showed you how far down the support is, and even if you break the 28.64, all you're going to do is have a very shallow rally into the 28.80s before the market is overbought and comes back crashing back through 28.64. So it's just a very short-term trade. 11.50 is very important to me in terms of volatility, and that is where if we can match volatility at 11.50 with, say, 28.90 up here in SPX, that's going to be a great trade, a great short-term trade, longer volatility, shorter the market, one or the other. And as I said, European equities, with the EM looking the way it is, 11,800 is going to be a very tough level to break. We're long of 11,800 put spreads for the long term, and we're going to stay that way. We see no reason why that should be anything but a good level to have. The dollar, as I showed you, instead of having these levels, I will amend it next week when it's moved. Now 95.07 becomes important, and I really cannot see the market doing anything at all in the dollar, while the 10-year note and the Bund are so tightly correlated in that 10 basis point channel. That will give us our clue, and then we'll know exactly what to do with the dollar. Thank you very much indeed, and tweet you in a moment.